Hello, hello, hello. What's going on, everybody? Welcome to Al Stock Trade. So my voice is gone. I keep doing this to myself, guys. I just can't. I just keep yelling. Right? I just keep screaming. What the hell's going on with United Healthcare? Jesus Christ, guys. All right, so this is going to be one of those videos. Um, we have a lot to talk about. A lot. So we're just going to kind of get through it. Yeah. Let's see here. Yeah, dead. Pour one out for United. Moment of silence for the bag holders. Somebody needs to get Bertha on this live. Michelle, turn down the AC. What's going on? Yes, guys, if you can, smash the like button. It helps with the YouTube algorithm. Hey, I'll close to 320 because of the thieves of UNH. Well, we're gonna be doing something today. There's a lot of amazing things. We got to look at the Bank of America conference as well. I mean, I don't know. I haven't listened to it yet. Let's see if we can. Let's see if it is uploaded today. Whoa. What? Weird. Let's see. Investor presentations. Hmm. Oh, good. So I can just go ahead and register for it. All right. So we can listen to it. Let's see if it works. Excellent. All right, good. So we have that set up, guys. Wanted to get that done, but there's a couple things I want to talk about. First things first. Yeah. So, yeah. Today we're down about $22,000. So we're down 22. On the week, we are down $137,000. We are down Monday. Woo! Right? We're down. We're down. Right? On the month, we're down 98,000. That's not too bad. 137 looks worse. 3 months, we're down $315,000. Woo! Oh yeah. Year to date, we're up 27%. I mean, sorry, 27,000, right? And on the year, we're up $492,000. Okay. So and just a few weeks ago, months ago, we were up 1.42 million. All right. So what I wanted to do is I want to talk to you about this guy named Dividend Dude. And he pretty much said this today. He said, now I'm sure what is better risk reward? Is it Google or United? In my opinion, these two are the best risk rewards in the market right now. He said this 22 hours ago. I went ahead and responded by a quote, and I gave him an essay. And I don't know if he saw it, but I'm going to read this to you, but I just want to show you just right now about, an hour ago, 2 hours ago, as the stock goes down, he says, I just want to be clear. This is not as obvious as I thought with the news today of UnitedHealthcare, UNH being investigated. Not sure what I will be doing with my position now. This is not as simple as I thought. We'll update you guys when I come to the decision. Right? And this guy has around 46,800 followers. And now that he realized that it's a lot harder, right? He realized that it's a lot harder to essentially, invest, right? I went ahead and explained it to him. If only he read this, then he probably would have saved some money. So, oh, he's only 19 years old. That explains it. That explains it. I didn't know that, right? So pretty much people following 19-year-olds. That's how things work now in the stock market, right? That's it. That is amazing, right? Um, oh, 100%, 100%. So I said, um, no, I agree with you 100%. But yeah, you see what I'm saying, right? So, okay. So lately, a lot of people are, talking about the drop in UNH, United Healthcare stock. Many investors, let me just kind of zoom in here. Many investors see this as a great buying opportunity after all historic moments of fear in the market, often create ideal entry points. But this time, something deeper is going on. Most are looking at traditional valuation metrics like the PE ratio. However, insurance companies, especially healthcare insurance, require a different kind of analysis. You need to look at the medical cost ratio, MCR, which we've talked about a lot, which is the percentage of premiums spent on actual medical care. Right now, that ratio is under pressure, specifically for United Healthcare. So it, you know, why? So it comes down to rising senior utilization. So I went ahead and I said, roughly 10,000 Americans turn 65. Again, this is the post that I did. Roughly, 10,000 Americans turn 65 every day. That means more people are aging into Medicare and private Medicare Advantage plans, which is what United Healthcare and obviously Clover Health is. These individuals are not entering the system in perfect health. They often carry multiple chronic conditions, diabetes, heart disease, kidney issues, which create a compounding effect on medical costs. As as I'm a medical student and future physician, I see firsthand how these diseases interact, often spiraling into costly and complex care needs, right? So this surge in high cost patients is increasing the financial burden on insurers like UNH, while investors are focusing on the stock drop as an opportunity. They're thinking only at the first order level. The stock is down, so it must be undervalued, right? And that's the issue, right? So stock's down, it's undervalued. Let's go ahead and buy it, and okay, right? So the problem is they're not thinking in terms of second or third order effects. Why is it down? What structural pressures are causing this? Will those pressures persist or worsen? The issue isn't just macroeconomic noise, it's systemic. Reports have emerged that UNH and similar companies have been using tactics like upcoding, classifying patients as sicker than they are to receive higher Medicare payments to offset rising costs. Again, this was posted before the DOJ investigation, and it doesn't take someone to be a doctor to figure that. Maybe it does to figure this out. Maybe I have a lot of inside information from being in the healthcare space, but I think everyone knows that these insurance companies deny. Okay, all right. So so this isn't just about a regulatory risk; it's about a sustainability of their business model. They can't keep patching holes in the system with questionable practices, especially when oversight is tightening, right? So this doesn't mean healthcare is going bankrupt. No, far from it. Demand for healthcare will only rise, but the structure of the delivery administration is being disrupted as we speak, right? So that brings us to a broader point. The entire healthcare industry is ripe for transformation. Think about it. Blockbuster never saw Netflix coming. BlackBerry underestimated the iPhone. Taxis didn't anticipate Uber. Each was disrupted not by a better product, but by a smarter platform. So healthcare is heading into the same direction. So, technological moats are forming in real time. You got large language models. You got I started talking about how these board exams are, essentially passing LCME accredited medical schools. And as you guys, I've told you, I'm writing a paper with the chief scientific officer from Microsoft in regards to these large language models on LCME, accredited medical school, graded NBME exams, and it's smoking them, right? So the fact that AI models now can outperform in this arena is a signal that change is already here. So the future of healthcare will belong to those who blend deep medical expertise with technological infrastructure, companies that can scale care, personalize treatment, and reduce insufficiencies using AI data and automation will define X, Y, and Z in the next compounders. So no, this isn't a bet against healthcare. It's a call to look deeper. Don't just buy fear, understand it, question the model, study the moat, and above all, recognize the signals of disruption because they're already here. And that's what I'm trying to tell this guy, right? So yeah, I went ahead and I commented just about 23 minutes ago, and I went ahead and I explained it. When did I post this? I posted this today at 8:06 in the morning, and I tried to explain to him kind of what's happening from the disruption, and I gave it to him here, around here, and then obviously the stock dropped into 10%. And obviously I've been short United for a long time, right? So I'm short all these healthcare stocks, right? So there's that. So I messaged him, but 24 minutes. Hopefully he responds. All right. So, oh, by the way, shout out to Batty. She's right here. What's up, Batty? Yeah. So, this was a study done. New study reveals 75% of luxury purchases are made by middle and low income shoppers. And I said, yeah, of course, because the rich buy assets like Clove, Palantir, SoFi, Amazon, right? So, let me look at the chat. 100%. Yeah, no, yeah, oh yeah. You've noticed? Yeah, right here. Yeah, I'm wearing my kippa, right? It's a good reminder to tell you. It always reminds you essentially that there's always someone above you, right? And that's God, right? Let's see. All right. Let me go ahead. Can you send a tweet and tag Andrew Toy, RFK Junior Coach, ID Elon, and notify, and then say taxpayers money buy using CLOV? Well, I'm sure they know now, right? I'm sure they know now. Well, here's the thing, a lot of these new investors, they come in, CLOV doesn't look as attractive, and it really requires really deep financial analysis. So of course, I wouldn't, a lot of these folks start talking about stocks when, everyone's talking about them. And that's when it's too late to invest in, like Palantir. And getting in Palantir now is just insane, right? You should have gotten in when it was $6, right? All right, guys. So yep, no, I certainly am. Yeah, certainly am Jew. Yep. I'm an Arab Jew. Let's see here. Large shifts are not able to easily change direction. When age will take a long time to correct. I agree with you. I agree with you. Yeah, so it's tough because in terms of UnitedHealthcare, there's a structural problem right now, and there's rot and there's cockroaches coming out. So it's hard. I mean, obviously, if it's a true company, it's easily worth $500, $600, right? Watch. Let me show you. So if you go ahead and if you open up our proprietary stock terminal, again, for folks that want access to our stock terminal, I went ahead and let me show you here. Here's our price target, and here's our price target software, right? And this is kind of the stock terminal here behind me. It's I created this, I coded this. This has helped me become a multimillionaire, and I believe it can, it can help you as well. Unfortunately, guys, let me go ahead and see if I can fix this here. Unfortunately, guys, if I have to say something, if you were to get a Bloomberg terminal, it'll cost you $2,600 a month, and you have to pay quarterly, right? So you take 2,600 multiplied by 3, so it'll cost you $7,800 every 3 months. And the reason why they make you pay quarterly is because oh, look what Michelle brought me. It's hot. What are this? It's really hot. She brought me edamame, but they can't see it because it's green. It looks like a bunch of looks like the stock terminal. Yeah. So, oh man, what Michelle? What was I saying? I lost my train of thought. See what you did, Michelle? What the hell? Why are you doing nice things? I have to think. Oh yeah. So the Bloomberg terminal, it costs, they make you pay every quarter because then people will just use the terminal every 3 months, and they'll just spend 1 month to use the terminal, $2,600. So it's $2,600 times 4, right? But they make you pay quarterly these, right? So you're forced to pay for 3 months in advance. It's disgusting, right? So that's why I created my own platform, right? But let's show here, you guys. You put in UnitedHealthcare, and it calculates the value of the stock, right? And you get a bull case of $6.30, base is 456, bear is 352, and recession is 200. But the problem is they're upcoding. We don't know if what they're doing is legal, right? So we don't know that. We really don't know what they're doing is actually legal. So, it's actually, it's actually quite dangerous if you ask me, right? So I'm gonna wait, right? Jim Cramer saying today people should sell part of their Palantir shares. Man, Jim Cramer just says a bunch of crap. I'm in Palantir from 16. Yeah. Oh yeah. Sell those freaking right. So it's from Iraq, right? So we're kind of the old school Jews, right? You don't really see a lot of us. That's why I look a little different, right? But yeah, so obviously I have some Spanish, Italian in me as well, but we're old school Jews. All right. No, it's not. No, it's not glued on, guys. No, it's not. Look, it's not. Just many years of experience. Just kind of, just sticks on, right? By the fear of God. All right. All right. So, let me think. Oh, hey, what's going on? Oh, yeah. Oh, yeah. I know. I love your brother. I know. Yeah, that was a good joke, right? Yeah, no. Yeah. Do not leave. That's, do not leave at all. That this company is there for the long term, and it's just predicting free cash flow for the next 3 years. We'll make, we have to make a dedicated Palantir video. We really do. And I have to redo Robinhood. We called out Robinhood at $9, right? So there's a lot of good stuff. Okay, so let's go ahead and we talked about kind of the intrinsics of United. Oh yeah, this is us pretty much. Right now this is us. Let me show you. This is us. Right, so that's I like the flash, so that's me. I like to be fast, but my lives are slow as hell. And where's Andrew Toy? That's Alex Karp with his hair, right? Yeah, but as you guys can see, this thing's down, right? I mean, $283. It's down 8%. I mean, this thing's going to drag the whole market down. And a lot of people were saying, oh yeah, I got to put the helicopter hat on. I really do. It's in freaking Tucson, man. It's in freaking Tucson. Look at XLV, man. XLV is getting dragged. For people that don't know, the healthcare sector is down, guys. And the fact that Clover is up still 5% off of this madness really should signal to you that's pretty impressive. Obviously, it's trying to detach itself, but When a whole avalanche falls, it really makes a big noise. Humana is down 8% on the year. Now it's $226. It's even falling down after hours. Now, if you look at Clover, um, Clover is actually not doing anything after hours. I mean, it's so much. I mean, listen, guys. Um, Andrew Toy and the company went ahead and essentially bought shares at about $18.2 million at around $3.60. So, of course, I wouldn't expect this, to go any more down. But I bought today, by the way. I bought today, right? So I put another 10K. I should have put that in the title. I dropped another 10K, and I keep buying. You know what I mean? So, the more the merrier. I keep doubling down. My share count's increasing, and that's ultimately going to help us with the wheel strategy. Just like with what Batty's saying, right? Do those covered calls, enjoy it, kick some ass. You know what I mean? So let me go ahead and do that. Okay, so what else? Okay, we got that. We talked about, oh yeah, if you would have invested in Humana 5 years ago, you would be down 42%. So if you would have invested in Humana, imagine people are holding the bag. Jesus Christ. This is why every 3 months you got to keep checking on your companies, right? You have to keep checking, guys. Okay. So let me shout out very quick. Um so yeah, here's Humana, 5 years down 42%. Shout out. We just created this community section, and now individuals will be able to post their triple dragons, emerging dragons, and triple moats. I understand in the Discord it's hard because all these stock picks that you find that are going to like double, 2, 3, 4x. It's tough because they get kind of dragged around. So you click on triple dragon or emerging dragon. This is an example. You click on this, and then you basically kind of give the name of the company, Palantir. You shoot out its financials. So you look at the financials. It's high quality. You can essentially look at the operate, and this is what a triple dragon means. And then people that want to comment on your due diligence can press the reply and say yada 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 yada, and they can reply. And the beautiful part about this is it's organized in such a way that will allow you to really have a good, thoughtful discussion. So I'm very proud of that. We have that. And for folks that are interested, if you guys want access to one of the best stock terminals on the market that has access to not only the data to investors that have more than $45 million of net worth, and one of the best stock terminals that I went ahead and I coded this with my own hand and mind. You guys know where to look. We've had so many people sign up, but only a couple have integrated. So please finish the integration product, right? And then the stock terminal integration, we click the button. So it's a SaaS coupon code, $1,200 off. Mr. Will, thanks for the follow. Appreciate you, brother. And let me just kind of, because we're going to listen to this. So before we listen to this, we really got to do something here. I want to make sure we got this. Okay, so if you don't recall, ladies and gentlemen, I went ahead and I did some projections for Clover Health, and we were like projecting $50 million of net income profitability, right? We were projecting 50 mil. If you don't recall, if you go to sheet 2 here, we pretty much got 50 mil, and we got around earnings per Q, 3 cents. So 3 cents in Q2, 3 cents in Q3, and 3 cents in Q4. Now, obviously, if you were to go to Yahoo Finance, look up Clover, one analyst actually was projecting the same thing, and we went ahead and calculated it manually. Now, what I want to say is, I want to be a little bit more humble, because I don't think what happens if costs go up, right? What happens if Yeah, the first quarter, what we did is we projected Q1's 2025 from 2024s, and we projected that to Q2, Q3, and Q4. Now, what happens if costs start going up? So what I'm going to do is I'm going to do a conservative calculation. And, to be quite frankly honest with you guys, what? Oh, wait, let me see. Let me see if I can find it. I guess I can't find it. Oh, yeah. I want to be conservative. If you go ahead and look at this little sheet I made, I'm going to copy it and put it in Research Edge. But, we got about negative 1.3 million for Q1. I think Q2, instead of 37 million, we may get 14 million. It depends on stock-based compensation and all these other expenses. Q3 and Q4 maybe slightly negative. Obviously, potentially, we could be at a total net income of 11 million. Total net income of 11 million. The reason why it's funny, it's weird because watch. If you go to last year's prediction of 2024, they said that adjusted EBITDA non-GAAP is what is their projection? Yes. So their financial outlook for full year 2024, obviously they did this in 2023. They said adjusted EBITDA non-GAAP negative 20 million to positive 20 million. Now I find that pretty weird, guys, because watch. For the first time ever, they don't use this adjusted EBITDA language anymore. They're using this language here. They're using both, but they use this language here. Let me show you. So here's your adjusted EBITDA, but they use this thing, adjusted net income. For the first time ever, they use this thing called adjusted net income, which is weird, isn't it? Right? So, just if you can think about this for a sec. And, I want you to I want you to kind of comment down what you guys think. Why for the first time ever they're using this number? Adjusted. Why not just stick to adjusted EBITDA? What do you guys think? So cash flow, I think personally they changed the language because I think they're going to be near break even or near profitability. And they're like, well, wait a minute. We actually are going to be even more profitable than what we actually are, I think. And I just need, again, I kind of jumped the gun when I did the calculation for Q1. I need just another quarter to see kind of what they're going to be, because next quarter, they should be profitable. And I need to know by how much. Obviously, we set 37 million. Now I'm putting here, now it's 14 million. I'm kind of shaving off some numbers. Obviously, 11 million still. But let me just assume, let's assume something right now. Let's assume 2025, their net income zero. They're not negative, their net income zero. So let's go ahead and let's try to calculate what the free cash flow is going to be. So let me go ahead and move the keyboard. Let's bring out the iPad. Let me put the mic here. I got to stand now. One moment. Hold on. So now I'm going to drop this here so you guys can hear me better. Let's open up the screen here, shall we? Yeah, there we go. There we go. iPad. All right. Okay. Do you guys see this? Please tell me if you guys see this and let me know. Do you guys hear me? Do you guys hear me? Oh, wow. We got a lot of new comments. Sorry, I'm behind on the comments. The rule of 40 for SaaS. Absolutely. And Palantir is growing faster. We'll talk. We need to talk about that because most people don't know that. Yeah. I try to touch on it a little bit with the logarithmic calculation I did yesterday. Excellent. Excellent. Mazel tov. Love it. Love it. Good. You guys can hear and you guys can see. Can you see the screen? Okay. Good. So what I'm going to do now is let me see. You guys can see this? Okay, good. All right. So we got the iPad here. So we're going to get the pen and we're going to go all the way down. And we're going to go to the statement of cash flows. Okay. Where's the cat? Okay, good. All right, ladies and gentlemen. Let's open up the highlighter. This is net loss, aka another term for net income. Okay. So now let's see if we can understand. So these numbers are in thousands. Okay. They're in thousands, ladies and gentlemen. So let's go ahead and let's just, look at this let's look at this whole line right now. Okay. Let's look at this whole line. Let's zoom in, ladies and gentlemen, and let's just look at this. So this is all net income. Okay. Net income. Now, this is 2022, 2023, 2024. Okay. So, ladies and gentlemen, how many million is this? How many million is this? Comment down in the chat. How many million? By the way, shout out. We got 477 listeners now, 374 from Twitter, 103 from YouTube. So thank you. Thank you for the support. Excellent. So is it a positive 339 million or a negative 339 million? Is it positive or negative? Exactly. It's negative. How do we know it's negative? Because there's parentheses around it. Okay. And remember, this is the cash flow statement. Okay. This is the cash flow statement. So this is for 2022. They were negative 339 million. All right. 2023. What is it? How many millions is that in 2023? Comment down in the chat. Right? It's 213 million. Okay. 213 million. All right. How many million is in 2024? How many millions? Good. So good. And negative 43. So what do you so based off of this trend, is it becoming better or is it becoming worse? Is it becoming better or is it becoming worse? Michelle, can you lower the AC, please? I'm really hot. It's really hot. You know, lower the AC. Exactly. It's becoming better. Now, you know, this is 2020. No, this is 2024, right? For 2025, I'm just gonna put 2025 here. The only piece of data we got for 2025 is Q1. Okay, is Q1. Michelle, turn down the exponential. There it is. Depends on who's asking. Positive. Okay. Well, potentially, right? Oh, okay. So now now let's compare. Q1 2024 to Q1 2025. So to do that, let's go to our stock terminal here, and let's type in Clover. This is our own proprietary stock terminal. Let's look up the net income, and let's go here. So for Q1, we got negative 19. Oh, by the way, this is finally updated. Q1 is updated for 2025, which means we'll be able to do some magic, right? So Q1 2025, they got negative 1.27. So, and then Q1 2024, they got negative 19.17. You see how they improved? They literally improved. They went from negative 19 million to negative 1 million. You understand that improvement? They improved. Okay. So now I'm just going to take a little screenshot of this, and I'm going to put it here for me to look at on my right computer screen. So now that we have this, now let's put this in here. Okay. So for Q1, we got negative 1.27 mil. And then for Q1 2024, we got negative 19.17 mil. Okay. So obviously, Q1 is better. So now the $1 million question is the whole year of 2025 going to be negative, break even, or positive? Okay. So we're going to get to that. Okay. So what statement is this? This is the cash flow statement. Okay. So to calculate the free cash flow, all you have to do is you got to take Michelle, the AC's not working. She forgot to turn on the AC. I'm dying. Huh? Too hot. All right. So probably try to reset it. All right. So here's cash flow from operations, right? This discontinued, we're gonna forget about it for right now. Okay. That means it's not gonna come back. Here's net cash by operating activities. So here is your obviously final version of OCF. Obviously, this will be discontinued. So we can call this kind of the better OCF, right? And what you do is we subtract properties, plants, and equipment, which is this here. Whoop. Which is not that bad, right? So we subtract that to get free cash flow. B-Rob, you're so funny. So we're going to talk about the buyback, right? So now, what did I tell you about net income? if the net income is negative, does that get transferred and ultimately affect the cash flow? Yes or no? Does the negative net income ultimately get transferred and does it hit the cash flow? There it is, B-Rad. You got it. Exactly. The answer is yes, it affects the free cash flow. Okay, it does. Absolutely. So now let's talk face to face. Okay. What I'm trying to tell you right now is, okay, I think Clover is going to be profitable in 2025, which is this year. An analyst is thinking the same thing. But just in case, because B-Rad Cooley, you have suggested that Clover is growing faster potentially than what they're saying, that they may even need to revise. They are growing faster. And potentially, if they may grow faster, maybe they have to, spend more. What happens if they get a deal? Because now UnitedHealthcare is cratering and falling. Well, maybe they might sign a deal with Counterpart. So that might cause, for people that don't know, Counterpart is the SaaS of, the Clover Health, right? So, that might cause costs to go up. So what I'm saying is, I think, we're going to be anywhere between, 14 to 50 mil in net income. Let's assume we're zero. Okay. If we assume we're zero, well, that means we can add back $43 flipping million back to the operational cash flow because now this is positive. Mm-hmm. Okay. So then now let's go ahead and let's do some math. Okay. So what we can do now, let me kind of think here. Let me do some thinking. So what we can do right now, just for all intensive purposes, let's go ahead and what's the best way to do this? What's the best way? Let's go ahead and add up all the positives and negatives for 2023. Okay. So we'll add up all the positives. I'm going to open up my calculator here. I'm going to add all the negatives first. 213. I guess we can be specific. 213 plus 0.361 plus 4 million plus 7.2 million plus 1.689 million plus 2.9 million plus 0.294, which is this one. You see how I'm marking it so I know. You get that. You get a negative 229.4. Now we're going to do the positive 2.5 plus 140.9 plus 0.086, which is really nothing, plus 4.726, plus 15.945, plus 3.728, plus 8.859, plus 6.44, plus 4.739, plus 6.404. So you get 194.327. Now, this is a negative. So you go ahead now and find the total. 229.4 minus 194.327. You get around minus 335.073, which is kind of what we got around here. Obviously, I removed the smaller numbers but you see that? So you see how this net income gets factored in. I just wanted to show you so you can see it in real time, right? It was painful to add, but I just wanted to show you in real time because this shit's hard, and for you to see it, you believe it. Okay, so they were negative, but then they had discontinued operations of 109. They removed that, right? But still, you add those and you still get a really negative number. So now that you understand how net income impacts the OCF, let's assume the operations for Clover. And yes, I'm reading the comments now. Clover has no debt. Absolutely. So now let's assume, 2023, then, the net income was zero. Let's assume 2022, the net income was zero. So if we assume that, then all we have to do now is let's add. Obviously, it wasn't zero, but I'm trying to follow the trend, right? So if we do that, we say, with the assumptions, let's look at the possible net income. So the possible net income is going to be 213.361 added to, subtracted from 144.662. So in 2023, they would have had 68.699, just 7 mil. Now let's say what it's going to look like for 2022. So you take 339.567, add that to 203.926. Wait, sorry. 339 minus 203.926. 135 million. Now, you might ask yourself kind of why did it go down in that income if we're adding it? Well, because growth went down, and also they removed ACO, right? The point is, you can see that Clover, if they're profitable, they are a net income growing machine. Okay. And this, we're assuming a net income of zero. Imagine, let's say right now, Clover becomes net income positive. And they might this year. I know Q2 last year was positive. It was positive $7.41 million. Who knows? I mean, this is why I said I need one more quarter, because I'm going to be able to determine if it's either going to be 37 million or 14 million. If it's 37 million, then our calculation is intact. Clover's going to be profitable this year. If it's lower, then we have to we really have to redo our calculations, right? But now that we did that, let's now assume let's try to calculate the free cash flow. So now I'm going to erase this, and I'm going to say I want to know the OCF for 2025. And to do that, we're gonna assume the net income is zero. And if that's the case, then you have to add 43 million back into the equation. You also have to remember that unpaid claims are gonna most likely be zero, just like kind of or near zero, just kind of like how they were here, near zero in a way. They're not gonna add too much value. So what I'm going to do is I'm going to subtract minus 19.296 million, right? And then I'm going to add this OCF 82.45. And when we do that, we get 106.154. Now, of course, this is discontinued, but we also had this discontinued as well. So, but yet we still had 47 pop back in next year. So the question now is, we also had that 39 going out. So we can subtract 47 again, which I don't think so. I mean, that pretty much dropped in half. So if we can be safe, we could say, well, that's fine. We could just take 47 divided by 2, right? And that's 23.5. And we'll subtract, 23.5 from this. So we should get a free cash flow around 82.654. So the range would be anywhere between 82.654, or we'll just say 82.7 mil to 106.2 mil. And this will be your OCF. We'll just take it as FCF because CapEx is not that large. It's only a few off by a few. Now, what happens if what happens if the net income is higher than zero? Well, then that just adds to the free cash flow, right? So we're going to do two different calculations now, okay? Okay, let's see if we can we add a piece of paper? Can we add something here? That's fine. Yes, we can't. Let's bring this here. Let's erase this. So this will be our OCF. Okay. Now let's assume something. Okay. So we went ahead and we did the calculation for next year. And, we were getting some crazy numbers. We're talking like, $209 million with a 14% increase from 183 to 209. Now, I'm thinking because what could be the net income next year, and and this brings a point. Let's actually, before we move on to finish the iPad, this brings a point that I want to actually make. If we actually go to our if we actually go here and go to our quantum chart, again, this is all created and coded by me. I created this. It's all proprietary to our All Stock Trades members. If you're interested, definitely take advantage. Can you guys still see me? It says I froze. Can you guys still see me? Hello, hello. Can you guys still see me? Oh, okay. Everyone's brains froze. Okay, you guys still see me? I try to remove my picture, so maybe it might help with the data. I'm fine? Okay, good, good, good. Excellent. Okay, so then now let's go ahead and type in Clove. And then let's go ahead and look at analyst estimates. Now, let me show you how dirty these people are, okay? So you know how I told you one analyst was most likely telling the truth? So what they did is, in order to mess up the data, this is taken directly from how they communicate with each other. And people send their estimations. So you know what this guy, so there are two analysts that have reported EPS. We already know one of them. The other guy updated his analysis, and he said that Clover in 2027 is going to lose $750 million on the low end, right? It's going to lose it's never lost 750 million. It's going to lose 750 on the low end. And you know what they did? On the high end, they said it's going to make 888 million. You see that? So on the low end, they said it's going to lose 750 mil. On the high end, it said it's going to make 888 mil. Okay. So then when you look at the average, it shows negative $2 million. When in reality, they're going to be profitable, I think, in 2026. The point that I'm telling you is, you see how they're playing the system? Because they know that we're looking at this, right? But they didn't know that I know how to calculate my own earnings per share, right? Because all I've been doing is free cash flow this whole time. But they don't understand that I know that there's also a method of calculating intrinsic value using the earnings per share method. And yes, that is coming to the Al Stock Trades program. And there's also, for the analysts that are watching, there's also a way to calculate an intrinsic value using the dividend discount model when looking at different types of intrinsic values for dividend paying assets. So the point is these people, they want to try to confuse us, but they don't understand that our data, why do you think I look at the low and the high? So, because I've been doing this for 15 years, I know that these people play shenanigans to basically to offset it. So you see that? Because they did larger numbers, because then it'll dilute that honest analyst who was showing his real numbers. You see that? See how nasty these people are? Nasty, nasty people. Very nasty. So, UnitedHealthcare is down more overnight. Oh, yeah, seasonality of Q4 could cost them more. Exactly, which is why I'm having them at break even, right? Which is still good because it's still a free cash flow boost. Now, we're going to go ahead and we're going to calculate the intrinsic value. But let me look at UnitedHealthcare real quick, because I love me some United. Let's see. Yeah, we'll see what happens. Stock analysts don't love God. No, they're nasty people. They want your money, dude. This is hilarious. Okay, so now, now that I showed you this, this is you can see. We can look at it quarterly to see how dumb these people are. On the net income side, that's funny. That's actually funny. On the net income, they're in the quarter. That's really weird. On the quarterly, they're being honest, but on the you see, look, look at this. On the annual, you see how it's off. They probably don't know we have the quarterly button too. So let's actually calculate this for a sec. Hold on. Q1. Let me add this real quick. 10 point plus 28 mil. Then they have them losing 16 point. They have them losing 16. It's slight improvement from last ones, but yeah, I don't think so. I do agree with them I think they're going to be. I think it's going to be higher because if you want to know, they're full of shit. They thought in Q1 last year for Clover, it'll burn 68 million, when in reality they burnt 19 million. And then for Q1 of 2025, they thought they're going to burn negative 19 million when they actually burnt negative 1 million. So you could see how off these analysts are. And then we could look at earnings per share quarterly. Yeah, so you could see these are all botched. These are all botched. And they did this on purpose because they probably thought we don't know how to calculate our own earnings per share, but I do. Which is fine, right? But it shows you how nasty these people are. There's only 2 analysts, so it allows them to play games. So it's okay. So now that we know, we now know this will be our OCF. We can then now calculate the intrinsic value. So to do that, we can just kind of reload this. Go to Clover. And we could do the low end, which is 82.7. Obviously, if they're profitable this year, this number will be higher. We can grow them at 23%. And then that'll be anywhere between $4.91 to $9.52. So of course I believe Clover is going to go up higher this year, right? And then the high side is 106. Obviously, if they're profitable, they're going to be more than this. Then that's at $8.50 to $12.23. Now, let's assume they have another quarter of 30, because they said they're going to return to growth. So let's say they have another quarter of 37%. So you could say 37% plus 37%. Then we could do plus 9.33%. Divide by 3. That's 27.77. We do that. And this is where we start getting into the higher numbers, right? And let me just be clear. Wall Street, what they're going to do is in 2023, 2024, and a little bit in 2025, it was all about the investments in the transistors and the semiconductors that will create AI. In 2026, we're going to get investments in the applications of AI. So what does that ultimately mean? Well, ladies and gentlemen, what that basically means, ladies and gentlemen, is applications like Clover are going to be recognized, and I believe 2026 is going to be the year where we're going to go ahead and get it, right? So one thing you reminded me, guys, is what we technically should do. It's okay, whatever, because we have to technically subtract 18 million, which is the buyback. We can do that, but again, we have the base, bear, and bull, right? So that's fine. What I'm really excited for is what happens if money starts flowing in for the applications of AI. Then we can grow this at 37%, and this is where the magic comes in. This is when you start seeing $21 to $32, right? Which goes back to our logarithmic equation that we did yesterday on the iPad. And again, 0 SaaS is being added. I don't know any SaaS right now. I don't have that data. So again, this is all a buying opportunity. We're seeing institutional investors increasing. We saw Clover buy at $3.60. We're seeing them keep the treasury stock and use cash to pay off taxes rather than sell the treasury for the vested shares. So all together, guys, this is incredibly bullish. And so what I'm going to do now is I'm going to unplug the iPad. I'm going to unplug the iPad here. I hope you enjoyed it. Okay, I'm going to remove the iPad. I'm going to get the keyboard and just kind of send this up here a little bit. Okay. I'm going to put on the headphones so we can listen to the conference. And again, for people that want a deeper dive, be part of our Zoom calls, get access to all of our proprietary stock terminal data, all these amazing AI, different types of AI analysis tools we have, all of our stock picks and the team stock picks regarding the Triple Dragons, and access to this new thing we have called, very quickly, the Al Stock Trades communities. You just click on this here and you'll get communities here. You get the communities. You click on communities, learn with others, and now you're going to be able to access these. We just launched this today, so it's very incredible. Okay, so lots of great things to explore. We have the generative AI features as well. Okay, so you can use coupon code SAS. Will be expiring soon. $1,200 lifetime access. Again, it's the best on the market. Just wait till we start making $500 to $2 million a month, and it's just going to be an investment group that we're going to remove lifetime access. It'll be a $25,000 initiation fee, and then it'll be around $7,000 to $10,000 yearly dues. Again, to get access to this group. Okay. All right. So right now it's a very heavily discounted promotion that we're offering. Given that we're continuing to build, and people that get into Lifetime, they will continue getting updates through here on out. And what I'm basically trying to do is I'm trying to teach you how money is made in Wall Street. Like I literally coded this whole thing that you see here, and I'm trying to teach you exactly how these people make money, right? So with that, let's go ahead and let me find the oh, did it log me out? Let me see if I can find the registration. Excellent. Here. Okay. Let's download the slides. Let's stop the share of the screen. Whoopsies. And let's share the audio version. So let's see kind of what they said. Let's just look at their slides real quick. Remember, guys, I'm in medical school, so I'm able to understand this information if there's any medical knowledge. Yeah, very good. Again, this is everything we know. This is new information. Let me see. Wow. It's kind of weird, no? Yeah, it's about right. Just thinking out loud, seeing what MCR improvement. So increased membership. Okay. 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 So here, kind of what they're thinking. All right. So positions for strong membership growth. They got the 4-star payments, compounding favorable impact from CMS rate notice, which is the 9% effective rate. So that right there is going to increase it by 4%. Excellent. It's a flywheel model, which you know is successful. This is the team. Oh, this is different. I haven't seen this one before. Let me see. So they're saying full year profitability, but they're saying this is adjusted. So we'll see. We'll see. If they're profitable, then all the calculations that I did is going to only be bullish because then it's going to make free cash flow go up higher. Just want to make sure. Good. That's fair. That's good. Stock-based compensation. This is what they're saying. They're going to be profitable in a way. So that's good. We just got to get this number higher to offset this. Again, everything we already know. So now let's share this screen, and now let's go ahead and share the audio.
All right, so hi everyone. My name is Craig Jones. I'm one of the healthcare analysts here at Bank of America, and today I have the pleasure of hosting Clover Health and CFO Peter Kuipers. So with that, Peter, I'll let you take it away. I think you have a little presentation for us.
Thank you, Greg. We're excited to be here to talk about our first quarter results and the momentum that we have. So first, let's start with the first quarter results, which we published last week. Very strong results across the board. Medicare Advantage membership up 30% year over year. Total revenues up 33% year over year. Adjusted EBITDA up 279% year over year. And similarly, directionally, adjusted net income up more than 300% year over year. Now, you might wonder what is behind these numbers? What are the drivers? And we have a differentiated 100% year over year. Now, you might wonder with the first quarter results.
I'm going to replay it. I need you to look at net income, adjusted net income. Look at the percentage growth. It's like over 100%. We talked about this yesterday.
Which we published last week. Very strong results across the board. Medicare Advantage membership up 30% year over year. Total revenues up 33% year over year. Adjusted EBITDA up 279% year over year. And similarly, directionally, adjusted net income up more than 300% year over year.
You see how that 300%, remember we did that calculation. If you haven't watched that video, you're shortchanging yourself. Watch that video because I break it down into simplistic terms. See how it's above 300%? It shows you the exponential side of that net income. The next 3-4 years, guys, for Clover is going to be compounding. And all the people that are investing now are going to basically reap the fruits.
Now, you might wonder what is behind these numbers? What are the drivers? And we have a differentiated vision and approach. We are a technology first, AI-driven clinical health plan. So our goal is to empower every physician with the best technology in order to earlier diagnose diseases, to treat those earlier, with better health outcomes at total lower cost of care. And that model is working, as you can see in the results. Now, actually, how do we do that? So we have a machine learning and AI-powered platform that combines over 100 healthcare medical record data sources, essentially all EHR systems, pharmacy, labs, and also claims. It synthesizes that data to information, to insights. And then that's powered by over 100 proprietary models. And we were an early adopter of machine learning and also of AI. And we have a moat around this technology as well via proprietary IP. And how does this actually work in practice? So we are empowering PCPs or physicians at their practice level, at the point of care, at the time of care. So on the top right on this page, you can see that the machine learning and AI-powered medical records are condensed, summarized, synthesized, actually with insights. So a lot of data, you can get a lot of data in medical records. But the key here is to condense and get the highlights and the insights so that a physician can action as well. The physician using the software, our physicians that are using the software, can then have, of course, the visit with the patient, add additional symptoms, and can correlate and then help diagnose. What helps diagnose here then is the second step in our clinical model, where the AI and machine learning models come up with care management suggestions. So these are suggestions. We are off scale now and have been over the last couple of years. So these are powerful care management suggestions that a physician can adopt. And we've published a number of clinical academic white papers showing actually via A/B testing that these results are really powerful. A number of chronic diseases with physicians using the software can diagnose 12 months, 18 months, or even 3 years earlier, and can be treated earlier for better health outcomes and also at lower cost of care. So here's a summary of the latest clinical white paper that we published a couple of weeks ago on congestive heart failure. So what this shows, we were able to compare via controlled testing the outcomes for patients that were seeing physicians using the Clover Assistant software versus the ones that are not using Clover Assistant software. So what we actually found is that hospitalization for all causes for congestive heart failure patients is actually down 18%, and 30-day readmissions is down 25%. Now, that is very significant in healthcare. Another proof point that I think is really helpful to look at is HEDIS. HEDIS is a quality score within STARS. So we received the highest score on HEDIS for plans with greater than 2,000 members. And we did that in a PPO setting. The PPO means that so the health plans that we offer are zero premium and free physician choice. So it's pretty exceptional to have the highest HEDIS score in the country. And then the next PPO is not in the top 10. We thought it's also helpful to contrast the business models, especially given the current dislocation in the market and in the industry. So this slide here compares the business models of traditional MCOs on the right.
He says dislocation, aka saying that there's a mismarket price between what the market is valuing Clover at. Obviously, it's undervaluing it. Let's continue.
And the Clover model on the left. So we are clinically focused at the point of care, at the time of care, enabling physicians to make better decisions to provide medical care. And so that is a couple of months earlier than other MCOs are able to do that, which typically are more back office focused. So as a result, we can diagnose, or our physicians can diagnose diseases earlier, treat them earlier as well via care management, close care gaps if they are there, versus other MCOs being more delayed and reactive. Also, we're able to do this on a wide network, again, on PPO versus other plans that are mostly focused on HMO plans, which have restrictions on physician choice. Another point really to look at is that our results in our P&L are pure. We have no risk delegation. So that's really important to notice as well. Another differentiating factor is our home care. So our home care division is using the same software, the same medical records that the PCP is also using. So you have a longitude care path and care management. Then also our home care program is managed by MDs and doctors versus maybe nursing assistants, right? So that then leads to leading cost ratios, both on an MCR and an MBR level. So we are in a growth phase. Last AEP was very successful, OEP as well. We are very pleased with the results and the choices that new members have made. Again, we are a benefit-rich plan with zero premium with a free physician choice. So the midpoint of the guide is about 30% member growth for the year. And more importantly, actually, we did get this member growth in the right geographical areas. So if you think about our model, we want the growth to be around the areas where we have member concentration and where we also have PCPs using the software. So think about it as a land and expand strategy. Worked really well. We had strong growth in AEP, both in New Jersey and also Georgia, which we're building out further. Now then, financially, how does that translate to financials? So if diseases are diagnosed earlier and also treated earlier, generally that is at a lower cost of care because you treat earlier disease in an earlier phase. Typically, the treatments are at lower cost. So what we see in our cohort analysis, which we published in the last quarter earnings, is that if we look at the cohorts, so members joining in a year compared to members that joined the year before, we see a decrease of the MCR, so the medical cost ratio, of about 700 basis points from year 1 to year 2. And then we have an incremental 800 basis points in the cohort going from year 2 to year 3. So that proves out the impact of our model. Now, we're currently as a plan in 4 states, New Jersey, Georgia, Texas, and South Carolina. For the other states, we are offering the same powerful software, clinically focused, AI-powered with powerful outcomes, also to third-party providers and third-party plans. We have strong interest, both on a regional and also national level. We've already published some logos, and there's more to come. Our strategy here is to first...
I'm going to go ahead and pause this, and I'm just going to repeat it a little bit here. But I want to just... Oh, I appreciate you, Dr. Patel. No, I mean, for you to just make it, I love you, man. I love you a lot. What you call it? You know, you're on call. No, I get it, and I hope one day I'll have the same privilege to be on call and serving, you know, the same patient population. So do your thing. Let's see. Yeah, Benjamin. Yeah, so you hit it on the nod. Now, what I want to do right now is just kind of break things down and just kind of slow down a little bit because you know we haven't taken a break. He said that year 1 we get 700 basis point reduction. Year 2 we get 800 basis point reduction. You add those up, that's 1,500 basis points, aka 15%, right? So right now we're growing a lot. Obviously last year, right? This year we're growing a lot. We're growing more than 30% in terms of patients and in terms of 37% revenues. Okay. So from 2025 to 2026, you're going to save 700 basis points. And then from 2026 to 2027, you're going to save an additional 800 basis points. And then 2026 is after a year, it's going to save another 700 basis points. You see how it's like waves that collide against each other. But every time they collide, they add on to each other. So this year's growth, 2025, by the end of it, it's going to be, we can mathematically model this, but we got 700 basis point reduction, but we're also benefiting from another 800 basis point reduction from last year's people after their 700 basis point reduction, right? And then we get another 700 basis points from this year onto next year. Get it? And then another 800 basis points. So you can see how it's like a flywheel business model where it just collides on top of each other. And ultimately, like 2027 is going to look so beautiful that these costs are going to be so low that it's just going to be like a cash flowing machine. Then you have the rate notice and 4 stars. I mean, holy crap, guys. Let's look at Benjamin here. Exactly. There it is. Yeah. So let's go ahead and let's replay that.
In the last quarter earnings, is that if we look at the cohorts, so members joining in a year compared to members that joined the year before, we see a decrease of the MCR, so the medical cost ratio, of about 700 basis points from year 1 to year 2. And then we have an incremental 800 basis points in the cohort going from year 2 to year 3. So that proves out the impact of our model. Now, we're currently as a plan in 4 states, New Jersey, Georgia, Texas, and South Carolina. For the other states, we are offering the same powerful software, clinically focused, AI-powered with powerful outcomes, also to third-party providers and third-party plans. We have strong interest, both on a regional and also national level. We already published some logos, and there's more to come. Our strategy here is to first expand the number of lives that are covered by the software. Second, to generate revenue, and then over time, also profitability. And we believe that Counterpart Health can be a meaningful contributor to both revenue and profitability over time. And remember, when you look at the size of the market, there's about 35 million people today in Medicare Advantage, and underneath that, there's also a shift from HMO to more PPO. So very strong market fit. So again, looking at 25 as the focus, we're executing in 25. We have high conviction in our guidance and the profitability in every single quarter. So we have membership growth, revenue growth. We're balancing profitability with reinvestments, both in the technology and in growth and in home care. We're reinvesting in maintaining 4 stars or more, and also increasing benefits potentially and outcomes and improving outcomes. Again, I talked about Counterpart expansion before, and then lastly, we're also applying AI, of course, to internal operations and driving cost efficiencies there. Then looking at the guide for 25, again, high conviction on both the membership growth, revenue growth, profitability as well. In our last earnings call, we actually increased the profitability guidance ranges, and we have conviction also around the BER. As an additional note, the cost trends that we have seen and that we are seeing are in line with our expectations. Then moving from 25 into 26, there are a number of strong tailwinds. First, we think we're very strongly positioned for continued very strong membership growth. I think you've seen that some other players in the market have stopped marketing or have reduced commissions or are closing plans. We are also going from a 3.5-star payment year to a 4-star payment year next year. So that is a financial tailwind, someone that will likely reinvest in benefits. You've also seen the CMS final rate notice, which is additive and compounding to our tailwind of the moving from a 3.5-star to 4-star. And we'll continue to have benefits from cohort economics and additional capabilities of our clinical platform. And then also we are now seeing more and more traction also on the efficiency program. Now, putting it all together, what is the flywheel? So we're growing membership and growing also the usage of the software. It drives better clinical outcomes, better quality of life, lower total cost of care. It again drives more profitability that we then reinvest again in growth and technology. And that was what it was. Yeah, great. We still have time maybe for 1 or 2 questions. You want to do that? Yeah.
Yeah, maybe just talk about what you've seen as sort of, Medicaid relation trends that has industry have been calling out, sort of maybe it's a little worse. And maybe also like what we've been seeing,
Yeah.
what are maybe your picks?
Yeah, I would say cost trends are as expected. We saw some increased utilization regarding flu in January, but it tapered off really quickly in February and March and April, and also May so far. I would say we're positioned lower total cost of care. And again, clinical platform. And then also we are now seeing more and more traction also on the efficiency program. Now, putting it all together, what is the flywheel? So we're growing membership and growing also the usage of the software. It drives better clinical outcomes, better quality of life, lower total cost of care. It again drives more profitability that we then reinvest again in growth and technology. And that was what it was. Yeah, great. We still have time maybe for 1 or 2 questions. So you want to do that? Yeah.
Yeah, maybe just talk about what you've seen as sort of, Medicaid relation trends that has industry have been calling out, sort of maybe it's a little worse. And maybe also like what we've been seeing,
Yeah.
what are maybe your picks?
Yeah, I would say cost trends are as expected. We saw some increased utilization regarding flu in January, but it tapered off really quickly in February and March and April, and also May so far. I would say we're positioned differently than maybe others because we have earlier insights, because we get insights directly at the point of care. Yeah.
For the visibility there. So maybe on Part D, right? We've seen some changes this year. Any color you can provide us there in terms of how that's maybe reshaping your seasonality, or just anything you can give us there on Part D this year would be great.
Yeah, first of all, we believe, without having insights in the internal workings of other plans, that we probably bid very well on Plan B. The trends are as expected. So we feel really comfortable there. Again, because we have earlier insight from clinical perspective, we can manage that also better than other plans.
Yeah, absolutely. All right. So we got a few seconds left here. So maybe, as we kind of think about, Clover's kind of zigging when everyone else is zagging, right? So for the last few years, you shut down growth, profitability went through the roof, right? The industry leading MLRs.
Yeah.
So now when everyone's kind of shutting down growth, now you're flipping right around. So maybe talk about sort of strategically, like how you think you're positioned versus your competitors, and how you think you can
That's a really good question. Let's go ahead and repeat that. I like that question.
win in this environment. Your position versus profitability. So kind of think about
Bid very well on Plan
Let's
B.
repeat that.
The trends are as expected. So we feel really comfortable there. Again, because we have earlier insight from clinical perspective, we can manage that also better than other plans.
Yeah, absolutely. All right. So we got a few seconds left here. So maybe, as we kind of think about, Clover's kind of zigging when everyone else is zagging, right? So for the last few years, you shut down growth, profitability went through the roof, right? The industry leading MLRs.
Yeah.
So now when everyone's kind of shutting down growth, now you're flipping right around. So maybe talk about sort of strategically, like how you think you're positioned versus your competitors, and how you think you can win in this environment.
Yeah, so I think we're very strongly positioned, specifically in the markets that we are in. You see other plans pulling back, closing plans, stopping marketing. We are very strong on the PPO basis as well. And keep in mind that in New Jersey, we probably are around a 12% market share. So there's a lot of growth to be had. And then similarly for Georgia as well. So we believe, and we said this in the prepared remarks for earnings, that we actually will see an acceleration of both revenue and profitability growth in the years to come.
Yeah. All right. Love to hear it. Well, I think we're out of time, but thank you so much.
Thank you, Greg. Glad to be here.
All right. Well, that's really great. So, it's kind of interesting. He's saying that, when, Clover zigs and zags, and essentially people are now starting to take Clover Health seriously. And they're starting to realize that they're doubling down as people are pulling back. And they got 12% market share in New Jersey. And this is going to basically grow until it's a dominating player. And they might even be dominating in all these other states that they're already in. And then you have counterpart, health. So this is very encouraging. Here's the thing. This is a heavily retail dominated stock. And I believe, personally, I believe that as the stock goes higher and higher and it reaches its intrinsic value, I believe that, we're going to get to a point where we're going to be able to do wheel-to-wheel strategy and covered calls and essentially be able to compound our money and be able to make $200,000, $300,000, $400,000, $500,000, $600,000 to $1-2 million, right? As of now, I can make $125,000 a month, but I choose not to because I'm sacrificing that potential $1 to $2 million a month, in which then I can buy properties and whatnot. You'll be catching me in Malibu and also South Beach, Miami, baby, right? So, and of course, our lifetime members, right? The goal of the channel is to really show you how Wall Street makes money, right? How people, like these folks win. And I've been winning for a long time. I got this, equation that is my proprietary intrinsic value calculation that I created that is the most accurate in the market, to a point where you just type in the ticker symbol and it gives you the stock price. And all you have to do is just check the free cash flow and, like a surgeon, curtail your analysis to fit the company. And then you can make a shit ton of money, right? Then you have a bunch of, people that join our platform and, they're searching stocks, doing their due diligence, and it's really good. So I'm very bullish on Clover. What I wanted to do really quickly is Bertha, and it shows you how these people, they really, they're so defensive over United because a lot of people lost money. A lot of people look stupid right now. You know what I mean? They tank to a 5-year low, and then a spokesman tells CNBC UnitedHealthcare hasn't been contacted by the DOJ about a probe, adding Wall Street's reporting is deeply irresponsible, as even it admits that the exact nature of the potential criminal allegations is unclear. We stand by the integrity of our Medicare Advantage program. And the thing is, the damage has already been done. Right now, you have a senior that's in New Jersey, right? That's going to be like, well, I don't know. I'm reading from the, news that United Healthcare is saying that, potentially that, they may be, I don't know, that's how old people sound like, right? I don't know. And they may be doing some fraud, and I don't want that, right? So this is actually pretty good, right? So it shows you that, Clover may start dominating market share as well. And who knows, maybe, this leak was from the administration and they're about to go down hard on United. Who knows? We already know Bill Ackman wants to go hard on United. He has a psychological short on United. And, we could go ahead and take a look at Bill Ackman's post here real quick. And then he basically immediately retweeted this. And you don't know if this was paid by, people that are shorting the stock. And let me be clear, Bill Ackman is not shorting the stock. Bill Ackman is not shorting stocks right now. Okay. Bill Ackman is not shorting United Healthcare. Okay. I want to be very clear with that. But maybe somebody, I don't know, right? But clearly people are, right? But it's interesting that Bill Ackman retweeted this. It's under criminal investigation, and this got about 947,000 views. And then, now, let's look at his other comment with United. He sure is a heavy user of Twitter. I could have sworn that he. All right, let me see. I could be wrong here. I mean, okay, there it is. So on February 4th, I wrote on X and I said, I would not be surprised to find that United Healthcare's profitability is massively overstated due to its denying of medical necessary procedures and patient care. And I encourage the SEC Gov to investigate this. Obviously, this is under Trump's administration. The company then attacked me and accused me of market manipulation. At the time, the stock was trading in excess of $500 per share. Now that the facts are in, it's entirely clear that the rot is deep in UNH. As I have previously explained, we have never had a position long, short, or otherwise on United. But it seems as there's a lot of cockroaches right now coming out of United. And this thing got 2.2 million views, and then this thing got 747,000 views, but this thing got a lot of views. It's obviously, this thing's been going down a lot. So, is it a good buy? Who knows? It is, employed 400,000 people. But what I'm trying to basically tell you is right now, there's a systemic change happening in all the Medicare Advantage platforms. You already saw Humana get hit hard, right? We saw it being denied. The star ratings increased. Now it's at 3.5 stars. You're seeing disruption happen. Okay. And it's great. This is really great because, a good example just to kind of give you is, look at Humana and look at a year. Humana's down in a year 33%, right? Look at UNH, United Healthcare. On the year, it's down 40%. But then look at these other stocks. Look at Alignment Healthcare. Look at Alignment Healthcare. It's up 113%. Look up Clover Health. On a year, it's up 224%. There is some form of money moving around, and it has to deal with essentially the possibility that there could be a disruption. right? We're talking, Blockbuster to Netflix, right? BlackBerry to Apple. We could see a disruption where the users of technology can help decrease costs. And let's face it, Social Security and Medicare and Medicaid is literally, CMS is literally causing this country to go bankrupt. So we have to figure out a way to decrease costs. And ultimately, I think empowering the physician with powerful software, what Clover Health is doing is great. In fact, there was a podcast today which we're going to stream soon. It talked about what you call it. It talked about how Clover's mission is to improve every life. So and we're gonna go over the questions for Counterpart on another video, but they may potentially go after Medicaid lives as well. Right now they're focused on Medicare Advantage, but I'm just saying, right? By the way, shout out to our viewers here. We have about 512 viewers on X, and we have about 87 on YouTube. So you can see here, we have about 599 people, 512 on X, and 87 on YouTube. So that's really cool, right? So that's great. So all in all, guys, I think the rot is pretty big at United. Big thing is XLV, which is the combination basket of stocks, has been basically being pushed down because of United. The Dow is most likely down today. I'm sure the Dow is not doing any good, right? The Dow is down 143 points, and obviously it's been down for the past couple of days, right? So we'll see what ends up happening right now. We could get a rebound because I'm denying this, but I think the United can't catch a break because the news is out, the damage is done, and I just don't think that they're in a good position right now. Now, very quickly, for the folks that are watching, I really wanted to point this out right now regarding the stock terminal, right? We have access to 2.5 billion outputs of institutionally graded data. The people that have joined our platform and the lifetime access, a lot of them, within a couple of months, they've made $200,000-$400,000, right? Our platform works, and we will be increasing prices soon, and this SaaS coupon code will be expiring. So take advantage. Coupon code SaaS, SAAS, gives you $1,200 off lifetime access. This is a software I coded, I programmed, and as you can see, this this is our public portfolio. We're going to be showing this. This will soon turn into a 5, 10, $20 million portfolio. You could just see a few months ago, before the Liberation Day, we're at 1.4 million. You can see in a year we're up $492,000. So obviously I went from homelessness to becoming a multimillionaire. I started from nothing, and the people that are in our platform now, we've took a survey. We have a net worth altogether of approximately $45 million. I believe when the stocks that we talk about hit intrinsic value altogether, I believe we're going to have a net worth of over $1 billion. And I want you to be part of this group. I want you to be able to see the beauty of what compound investing can do for you. I want you to see the beauty of having like-minded people all around the world that want to make money, and that always try to find a bull, irregularities in a bull market and any type of market, right? And ultimately be able to use data-driven tools to win, right? So for folks that are interested, for folks that want to be able to change their life, to break out of the matrix, to essentially go from zero to hero, I will be able to take you from being a beginner in the stock market to literally being in the top 1% and being able to master the stock market. So ride with us on this journey. Join a beautiful group of like-minded people that want to take it to the next level. Okay. So very quickly here. Let's see here. I'm always wondering why Al does, talking about sleepiness, but his face skin still smooth. Yeah, I know. It's all the caffeine, baby, right? It's all the caffeine. But when you have a good heart, you have a good face, right? Right? There's no medical backing to that. Maybe, who knows? But love you all. Again, beautiful community. If you like this, hit the smash, the like button. It helps with the YouTube algorithm and also the Twitter algorithm, I assume, right? It's the same algorithm, maybe. But I love you guys, appreciate you guys, and I want you to be able to see the value, how it feels like to make money. Yeah, sometimes it's nice to, be able to buy material things, but what's even better is being able to be financially free. And what I'm trying to teach you is being financially free, because soon what we're going to do is we're going to be able to utilize these shares, and I'm going to teach you how to do the wheel strategy to turn this into a cash making business. And then we can take that take that cash and buy properties. And after buying properties, when the market's in a recession, rates go down, right? We pull money out of that property and then we buy stocks at a discounted price, right? And then we rinse and repeat. After 500, 600 days, stocks go back up, right? If you look and study all the recessions in history, then your tenants pay off that mortgage that you pulled out. And then you go ahead and do the wheel strategy on the stocks that you bought at a low valuation. That essentially money comes out of the wheel strategy, nets you and buys you more properties, and then you're able to rinse and repeat. Again, I have access to a large group of people that have a lot of money, and they also like to teach, right? We're going to have beautiful summits that are going to be exclusive to our lifetime members. It's going to be accessible to our golf course that we own, and also the other golf courses that we're soon going to be purchasing all around the United States as we formulate acquisitions. And we're going to most likely be able to, we already have one in Oregon. There's going to be more golf courses all over. And we're going to be able to create a community of like-minded investors so we can pocket and move around and have these summits, right? Again, we're not the most flashiest channel, right? But at the end of the day, our research and our data analysis runs deep, right? And you can speak to a lot of our Lifetime Access members, and they too can basically say the power of the Lifetime Access platform. Ladies and gentlemen, I wanted to thank you for watching our channel. God bless you all, and may United Healthcare rest in peace.